So far, Thursday, the lead from Wall Street strong, remember. Take a look at this. Korea's up more than 2%. Tokyo's up almost a full 1%. Sydney, we've been talking about the stunning political comeback of Kevin Rudd down there. Separate, though, in the markets, looking good, about 0.75% to the stronger side. Even Kiwi stocks are in the money as well, up about, call it, 0.5% for the top 50 down in Wellington. Let's get to Johanna, Chua, Chief Economist, Asia Pacific at Citi. She joins us live up in our studios in Hong Kong. And around the desk with us here at the SGX, Kenneth Akintewe joins us, Portfolio Manager at Aberdeen Asset Management. Both of you, great to see you and appreciate your time for because we're paying for a satellite. That's expensive. Johanna, let me start with you. We've got a risk-off environment. Long dollar Asia is the trade. We've got 260 odd, almost 270 on the 10-year. What are you telling clients right now?
Well, we've had very sharp moves already in Asian currencies, triggered by two major developments, right? Expectation about the Fed taper and the tighter liquidity funding conditions in China that have raised concerns about growth. But having said that, we've had big moves, and now at least we're seeing some signs, at least early signs, that the backup of U.S. yields seem to be coming off a little bit, and funding liquidity conditions in China at some point marginally is somewhat, somewhat easing. So I think now we should look at Asia and try to look at the differences and the fundamentals to see, well, which countries are really more vulnerable than others. And, lately we've been saying that, markets, countries that are very exposed to lots of portfolio inflows in the last couple of years in a very accommodative environment, we may have to reprice risk a little bit. Current account deficit currencies like INR has certainly taken a hit. But clearly, I think rupiah is still vulnerable, ringgit is still vulnerable at the margin because of the sizable portfolio inflows. But, I'm not really sure that peso or Taiwan or Korea or Sing should be as vulnerable. So now it's time to find a little bit more relative value after the big sell-off that we've already seen.
Interesting. So that's one layer, Ken, that Johanna was talking about. That is economies which are running current account deficits, which have economists worried. In the case of India, let's say 5%. Indonesia, maybe 3-ish, but worth keeping an eye on. At another level, though, the countries which are most vulnerable to a slowdown in not just capital portfolio, but also FDI inflows, in your mind, would be what? Which ones? FDI, to be honest, I think portfolio flows are still more important at this stage than the structural flows. Okay. I think the growth story in Asia is still going to be very strong, so you'd expect the transition in FDI to be much slower, if at all, in some cases. The fundamental backdrop for Indonesia has deteriorated, but if you look at the FDI flows, they're still very sturdy, have been very firm. But from the portfolio flows, that's slightly different. It's been interesting in this sell-off that, some of the currencies with the weakest fundamentals have been underperformed by some of the currencies with the stronger fundamentals, like the Philippine peso, for example. And this is purely down to positioning by clients. And in fact, one of the ways you could have actually predicted which currencies were going to underperform would be to go to a lot of the conferences that the banks have done over the last 12 months, find out which currencies the strategists are recommending, and make sure you don't position in them.
Kim, what do you think this is a twilight period, though, for Asian currencies? What are you seeing?
So 10 years ago, the quality of growth in Asia was not very well balanced. Currencies were very undervalued. We've had 10 years of appreciation. It's much more difficult to argue that currencies are very undervalued at this stage. In some cases, there are some degree of undervaluation, but in those cases, it tends to be where actually there is a fundamental weakness, so where there are current account deficits in the likes of the rupee or the Indonesian rupiah. The other thing is, for the last few years, of course, we've had a lot of liquidity coming into the Asia region, driven by quantitative easing policies, particularly by the US Fed. And it was always going to be the case at some stage that liquidity was going to be withdrawn. It just seems to be happening a little bit sooner than the market anticipated. But the good news is, markets do tend to reprice very quickly. If you look at the 2003-2004 period, Fed didn't start hiking the rates till about mid-2004 yet. By mid-2003, the 10-year had already sold off about 160 basis points. And we could see something similar now, a very sharp repricing, in which case clients should actually be looking for those opportunities rather than necessarily worrying about unwinding risk at this stage.
Okay. All right, Ken, stay right there. Going to come back and talk to you as well as Joanna up in Hong Kong more in just a bit.